Okay, it is Thursday, February 1st, 2018. Today's webinar topic, a top-down approach to daily preparation and its importance. Before I give the mic over to Jim to begin the presentation, I just want to go over a few more things with you guys. Housekeeping. I know you've heard this before if you've seen our other webinars, but it's something that I need to really reiterate because there are a lot of people who have written in and then let me know that they're not getting our emails or they're going into their junk folder. It's very, very important that you whitelist jimdaltontrading.com domain and mark it as safe in your inbox. Here are the instructions. You'll be able to get these instructions from the slides from the posted recorded webinar later on. And I just want to let you know that we're offering a special Valentine's Day promotion. If you use these coupon codes, you will be able to get special pricing. We've also sent out a marketing email. I don't know if you received it or not, but in case you did not, here are the codes for you. And these will be in the slides, accessible from the slides that are posted with the recorded webinar later on in case you're not able to jot them down quick enough. And another thing that I wanted just to show you guys real quick is because it is February 1st, we have kicked off Jim's live commentary on daily reports. And here is the dashboard that if you sign up with us, this is where you will find all the information that you need. The daily reports are right here. I can show you the one that we posted this morning. This is where you would find it, and you can also print them if you need to. Live commentary is here as well. Another feature that we've added to this is if you have Twitter, you can sign up for our private Twitter, and all of these live comments will also be posted to the private Twitter. That way, if you're away from your desk or you just prefer receiving Twitter announcements, you can do that, set it up on your mobile phone for that. So here are the comments that were posted from earlier today. Just a quick run through to show you that. Recorded webinars is where once we start our classes on February 26th, all of the webinars that we do will be recorded, and you will find them under this tab right here, as well as the daily synopsis videos, which will be a time-lapse video with Jim's comments pointed out through the day, and you can see how the day developed, and it'll be a shorter video for you, and additional resources where we have put things like our welcome packet and the webinar schedule. And just so that you all know that if you sign up, all of the GoToWebinar invites will be emailed to you. And I think that is about it, and I'm going to pass it over to Jim. 1 second here. Okay, I pass it over to you, Jim.
Let me know when you can see my screen.
Yes, I can see your screen.
Okay, let me just start with a couple market comments and then we'll go into the scheduled webinar. I don't know how many of you were with us for yesterday's webinar that was, both sides of the FOMC report. That is a very valuable webinar for short-term trading, and particularly short-term trading employing options. We have written a blog post. It has to be edited, but the blog post will be up, within the next, probably the next day. And also, there's the link that you can watch the seminar again and the trading that took place. I did do several trades. That's normally not what I do, but it was that kind of day using options, but it was an extremely educational day. We will have that up and you can go back and refer to it. Probably be up by tomorrow morning at the latest. All right, today, inside day. One of the things that I've commented on is the last 2 days it's very poor high because you have matching one tick apart, so there's no excess on those highs. We had a poor low yesterday, meaning no excess. And overnight, the market got down to the 2809, I think it was 25 level, which is the weekly low. It's bounced from there. It didn't make it down there this morning. And now, of course, we've had a double distribution day as this market took off. I was getting ready for the webinar. Was there any news that caused that? I didn't see. I was doing too many other things. But this is quite a strike out of this little balance. Support now is going to become yesterday's settle, right where the red line is. So if there's any fallback this afternoon, it will come back down through that settle, and then that would indicate that there wasn't much follow through. The upside target right now is the too high poor combination. Okay, let's go to the scheduled webinar, and let me get to the first page. Okay, I employ a top-down preparation routine, and the reason I do that, I do not start with the shorter time frame. And I'm going to guess that a lot of people do. They start with a shorter time frame. They're looking at the daily profiles. They're looking at their charts and technicals or whatever they use on a day time frame. The problem with that is it narrows your mind too much, and you don't see the possibilities or the imagination of what can happen in this market. I'm going to guess that there's an awful lot of people out there that for the last several months have fought this market and have put an awful lot of shorts out. If you start with the monthly time frame, we have been one time framing higher for 14 months. That means the long-term trend, the intermediate trend, all trends are up. And my guess is there's just a tremendous number of people out there that have fought this move, and probably some of them have fought it all the way up. And it's been a situation where, you should be buying breaks, taking profits on rallies, not selling rallies. It's just the wrong way to go. But anyhow, start with the long time frame. And the reason for that is to fight the biases that we all have. I am no different than the rest of you. I fight those biases all the time. And I can tell myself, boy, I don't like this market or whatever it is. But this helps me keep an objective move. So I start with the monthly. Following the monthly, I then go to the weekly. And I say, okay, what is going on in the weekly? So I look at the weekly, the last 6 weeks, it has been one time framing higher. So both the monthly and the weekly are doing nothing but showing the market to the upside, which means you should be out there looking for opportunities to buy breaks. And my guess is that's not what a lot of people have done. Now, coming into this week, we have an inside. I made these charts yesterday, not today, this morning, but we have an inside week. Okay, that doesn't mean anything has changed, but it does give you the possibility that change could be coming up. But it hasn't changed yet. The overnight market did spike down to the weekly low, but then we came off of it, and the market's, of course, rallying today. So when I look at that inside week, more chance that I'm looking at rotational type of days, rotational type of trading. That's what we've had. So it's an inside week is a form of balance. So I've got the long term up by the monthly, intermediate term up by the weekly, and I now have an inside week. So I should be getting a little bit of balance in here. Once I get this perspective, I then go to the dailies. And when I look at the dailies, I say, okay, what are we looking at? The daily bar, we've got a gap down. So the gap down is a potential change. A gap means that something has changed in the market. Attitude or something has changed in the market. We have a gap down. We have not gotten back into that gap other than a tick or two. However, there is no real excess when you combine the last 2 days. So what are traders doing? They are mechanically selling any rally back to the bottom of that gap. So the alert I have is we haven't had any downside follow through. We don't have any excess on the last 2 days, and the weekly low is, you can see down where the arrow is. So it's it's a little ways away from there, at least where we're trading right now. So I do the monthly, weekly, daily in order to get some perspective on what's going on in the market. Then, and you notice I'm coming from the top down. Once I've got this perspective, I then go and look at the daily profiles, looking for more details. Now, Jen, before I go to the daily profiles, any questions just on what I have talked about so far?
No, not just on what you've talked about so far.
Okay. So when I get into the daily profiles, I look, and one of the things that comes to my mind, I've got the overnight sessions in here also. So when I look, again, all of this trying to keep perspective, I see that the all-time high occurred in the electronic or in the overnight market. Any of you that have attended things I've done before said, I will say that it is very unusual that an all-time high that's lasting is made in the electronic session. Probably in the last several months, I don't know, I probably 40 times or so I've talked about that, and every time it's gone back and taken out that all-time high. Now, sometimes, we may get one that's not what happens. I have seen markets that have made some fairly decent corrections, maybe 5% or so. But then after that correction is over, they come back and they take out the overnight high. But it's rare that you get a correction, a short-term correction, without taking that out first. But I have seen it happen. So where are we right now? So the short-term trend has turned down. It's turned down, and this is overnight trade. So it gapped lower on Tuesday. With that gap lower on Tuesday, the overnight market has turned down. We're now, I'm sorry. This is the gap. This is the gap down right here. This is the overnight high, Monday's high, the gap or the trade down on overnight on Monday, Tuesday's market in here. So you got some follow through, and then you got an inside day less one tick yesterday. And then of course we're inside day today, and as you just saw, we're running to the upside on a very thin market. But that's where we are at this point in time. So I go down, and when I look at this, I say, more and more, where am I? And I come down, I say, okay, right now, remember, coming into yesterday, I'm saying I've got an inside day, and I've got Wednesday was an inside day. And then, let's see, make sure I got the right day here. This would have been Tuesday, right? Or overnight. Okay, so I came in, and let's go to the real market just to make sure I get this straight. I'm going to take today off just so it doesn't confuse us. Okay, coming into Wednesday, the market opens in the morning inside the previous day's range, and in a period, it does take it out by a single tick. But for all practical purposes, we were trading an inside day. Now let me split this out. So remember, I was saying, okay, the market came down. The short-term trend is turned down. Yesterday, for most of the day, at least early on, it traded inside the previous day's range. So at that point, we were balanced. But as I get ready to trade yesterday, I'm looking and I'm saying, okay, short-term trend is turned down. In order to have any follow through to get the long-term trend to turn down, I'm sorry, the intermediate term trend to turn down, I have to trade below 2809.25, which is last week's low. Without taking out last week's low, then all I'm looking at is a downward, a downward short-term trend, but the market is balancing in here. And so yesterday came in and the market expected the market to be rotational, but then, what I said, we had a webinar yesterday, and I said I was expecting increased volatility, and there was two reasons I was expecting that increased volatility. First, it was end of month options expiration, which we have found has usually added volatility to the market. And on top of that was the FOMC announcement yesterday afternoon. Looking at those two factors, I'm coming into yesterday and after it opens, I'm expecting rotation. Now, part of my daily preparation is to also make a note, of what is expected on that day, what announcements. So I already knew it was end of month expiration. I know it's going to be an FOMC release. And so with that point, okay, I say a pretty good idea that I could get increased volatility today. So that's the kind of thing that I'm looking at. Now let's go back to the slides for a second. I didn't mean to go from the beginning. Okay, daily preparation. Information to carry forward. The all-time high occurred in an electronic session on the Sunday evening. I write that information down because it's so easy to forget it. And this is what we talked about before, but both the long and intermediate terms remain up with a potential change as the short-term trend is down following a large gap on the 30th. January 31st and second, potential volatility related events. First, end of month options expiration. FOMC completes a 2-day meeting with the announcement at the 2 p.m. Eastern time. I am mentally neutral coming into Wednesday. So I talked about that earlier, but now it is important to write it down. I'm not, smart enough to tell you what happens in the brain when you write something down. But I know from experience, just to say, oh, I understand that, I'll remember that. And writing it down is a total different process. Something different happens in the brain when I commit to writing. And it would have been very easy yesterday to forget the end of month options expiration. Probably wouldn't have forgotten the FOMC because that's such a big deal. But there's just a real value in sitting down, writing it down, making sure that you've got all the important factors lined up in the market. And of course, then you can see what happened yesterday. And I suggested go and listen to the video and read the comments on the blog because it is an extremely educational day. All right, let me open this up for questions, please.
And just so you know, everybody, the blog has not been posted yet, but it probably will later today so that you can go and check that out. Okay, questions. Does Jim believe the overnight break corrects the poor low from yesterday?
No, it's a great question. A lot of people think it does. No, it does. It does not. Um, and that becomes important in my trading. Now today, it didn't do much today because we were still inside yesterday. But no, it does not correct it. It doesn't correct point of controls. It doesn't correct any flaws in the market, anomalies, etc. Okay, great question. Anything else?
Sometimes the longer chart have bullish signal, but shorter chart indicates bearish. Which one should I follow?
Okay, let's go back to what is your time frame? And this is what just another great question, because this is one of the things that will confuse people to no end. But remember, most of the people that are with us are short-term traders. Most are day traders. A few go just a little bit longer. But if you are a short-term trader, then your emphasis ought to be on the short term. Otherwise, you will get cognitive dissonance and really mess things up. And a lot of times, so many times, the day time frame trades, so many times they are related to inventory getting too long or too short. And they have nothing to do with anything else in the market. Let me take yesterday as an example. If you were with us or you're watching this market, the market rallied following the FOMC announcement, and then it broke, and it took out yesterday's low, came back in, took it out, went down, rallied quite a bit, put it lower, rallied again, put it lower. And you could just see this thing kept going down, but the point of control up here, maybe it went down 2 ticks, but there was no real change in the point of control. And remember, the point of control is the fairest price at which business takes place. So we're watching this, and if anybody was with us yesterday, I had the 2830 puts, and this market, and I didn't buy them at the best price. I mean, the lowest I bought them was 2820, Larry, level. So you can see that's way here. But then the market kept going lower, kept coming back, kept going lower, kept coming back. People are asking, is the market getting short in the hole? Short in the hole means short at poor prices. And and that's exactly what was happening. People ask, why didn't you just sell the puts? And I said I didn't sell the puts because of an opportunity to trade against them. And that opportunity doesn't happen all that often, but it happens enough. And of course, yesterday was a great example because the market rallied all the way back all the way back to 2831.75. So we had a huge rally, even though my futures against the puts weren't purchased at the best price. It became a very nice trade in there. But what caused that? It was because inventory got too short. Now people talk about the poor low down there, no excess. Sometimes poor lows develop because markets get too short. Sometimes they have poor highs because markets get too high, too long. I've commented on that, and I've written about this before, that many times when I first learned about the profile, it was very costly to me because I didn't understand that poor lows and poor highs can be because inventory is too extended. Okay, other questions, please.
Yes, when doing your top-down analysis on bar chart, do you use overnight sessions or just the day session?
I just used the day session to the best of my ability, but sometimes the charts aren't perfect. I use charts from TD Ameritrade. I think it's Thinkorswim, and they're the adjustments they make. They don't have the overnight in there, but the adjustments they make at the quarters and months ends can be different. But basically, I try and do it with the day time frame trade, not including the overnight. Okay, other questions?
Are odds high that this pullback is not over, as the low of this pullback was made outside regular trading hours in the pre-market?
No, I don't consider that that the low it was made in the over-the-counter market, or made. I'm sorry, made in the electronic market. I put more emphasis on the fact that the all-time high was made in the over-the-counter in the electronic market. Um, okay.
You mentioned the Sunday evening high to note, but what about the prior week's high?
Now, the reason I mentioned the Sunday night high is because that was the electronic all-time high, and that's the only high up there that I'm paying any attention to. Very fair question. And what the thing you have to do, you have to be selective. You have to be selective at the references you use. A lot of people, and I've seen a lot of traders and a lot of people that have been with us, they'll send me their work, and they spend a tremendous amount of time going out and picking out references. What happens, and they pick out all those references, they mark them, and then they feel that they've really done a lot of homework and a lot of preparation because they've identified all these potential references. I think that can be very misleading, because what you really want to do, you want to have a few references, but you want to really get behind the flow and what is really going on in the market. That is far more important than going out and making sure that you've got all these references. Doing the references can mislead you. You may think you've really done a lot on your homework, but the truth of the matter is you've missed the bigger picture. And the bigger picture is to, take a look at top down, monthly, weekly, daily, and then get in with the profiles and see what is really occurring. I mean, I'm not saying don't have the references, but I'm saying people go back and they like 5 and 6 weeks, and they've got a point of control. It goes back there. That's not what's really relevant. Okay, other questions?
Yes. Can you explain when you say what you mean by no excess?
Oh, sure. Excess, there is no excess there. In other words, there's no single prints. Up here, there's excess from yesterday because there's single prints, but there's no excess when you combine the 2 days. Excess is just a better indication that the market is over or the auction is over, at least that particular offer. Okay, other questions?
With the overnight balance to short, do you have a bias to the long side to correct the late short overnight trade?
No. It's a good question. Let me put it back in here. Let me put all the markets. I'll put all the markets back. This may take a second for it to catch up. Now, this was yesterday's settle. Overnight trade, you had quite a bit of trade that took place above yesterday's settle. Then you had a lot of trade later on that took below yesterday's settle. So the market probably wasn't overwhelmingly short from overnight inventory. It may have been a little short from overnight inventory, but you had some balance, because early on, for a lot of times, it traded higher. Later, it traded lower. Probably closer. If I wrote this down, I would have had it as closer to balance than anything else. Okay. Other questions? Oh, let me ask somebody, since I was tied up, was there any news that you saw that caused a spike up? If anybody has an answer, just type it into Jen, and I'll take another question in the meantime.
Sure. Options question. When you want to enter a trade, do you buy the option, call or put at or near the money, or away from the money where it is cheaper to enter a trade?
I will normally buy my options one or two strikes out of the money, and and that just depends on on the situation that I'm looking at. But generally, I will go 1 or 2 strikes out of the money. Okay.
Do you treat, by the way, some people chimed in and said checked for news but didn't see anything either.
Okay. Thank you.
One person wrote in, Dow rebounds more than 200 points from low as Facebook shares soar. ECB's Nowotny, we are now in a situation where we should end asset purchase program.
Okay. You got, yeah, I mean, there's always that kind of news out there. Incidentally, before I've said this many times, when you have a news event and you're trading the market, you want to know when that event is coming out. You do not want to read the news once the event comes out. For example, yesterday in the FOMC, I never looked at what the news was from the FOMC meeting. And anybody that was live with me knows I had a fairly decent day. Was it perfect? No, but it was a very decent day. I could guess that they didn't make any change the way the market traded, but I don't look at the news. I have had professional traders tell me that that's one of the best pieces of information that I can give traders. Historically, I have found that traders that continually come to me that are struggling with the market, they know every piece of news. They've read it, and they'll tell me, well, what about this? You know, the GDP was soft, et cetera, et cetera. And when you're doing short-term trades, it doesn't make a difference. All you care is how the market reacts to that news. You don't care what the news is. You know, you and I probably aren't smart enough. We may think we are, but we're probably not smart enough to know the importance of that news. We don't, you know, you got to look at the changes that they make to prior months. Then you've got to know what was the secret whisper number among the big traders. And, you know, it's just something we don't have access to. And even if you did, I'm not sure it's going to do you any good. But I've had a lot of good traders tell me that's one of the best pieces of information that I could possibly give out. Okay, other questions?
Do you treat one time framing the same when it occurs inside the prior day as when it happens when breaking out?
That's a really wonderful question. The answer is I always respect one time framing. However, when it's like today, it's one time frame from the low this morning, other than C period. C period will stop one time frame one time. But you know, I look at it but I still come back and say it's an inside day. Ideally, if you have an upside breakout or a downside breakout, and it's one time frame outside of the previous day's range, I pay an awful lot of attention to that. Let's talk just a second about, you know, when you get a trend day. A trend day is going to, you know, if you get a market that's one time framing, it's outside the previous day's range, you've got a trend day on your hands. A trend day, at least a good strong trend day, will vary. What's all that blinking? Is that people leaving and coming? I don't know if we can change that. But normally, when you have a trend day, and it's a pretty good trend day, you will only get one time when that trend day stops one time framing. And that one time very often takes place late in the afternoon. If it stops one time framing, once in the morning, once in the afternoon, I'm far more suspicious of the trend day. But what traps a lot of people, they see the market going up all day long. And then they're just dying to get short. Oh boy, they're going to fade that market. And then they get that inventory correction late in the afternoon. They let it go a while till they're sure it's there. They jump all over it on the short side, and they find out that they've just shorted at the worst prices of the afternoon. Again, you really don't want to take my word for any of this. What you want to do is, when I make these observations, you want to look at the market and follow and see what the validity of that observation is, because the confidence comes when you've seen it yourself and it's your own observation. Okay, other questions?
Yes. Is there a way of knowing when you reach a reference whether the price will break through or go back up?
No, what you're always looking for, as I say, I don't care if the reference is a technical reference. I don't care if it's a trend line. I don't care if it's a Fibonacci. I don't care if it's a previous day's high or low or a multi-day high or low. What you want, if it's going through that reference, use the same thing, same analysis. Are we getting good volume or low volume? Is it rejected off of there or not? I mean, and that takes some context. You've got to look at how did it get there? You know, how did that market get there? Then you have to make your assessment. Is it going through or not? You know, there is no absolute way to tell, but you need to understand. And again, if you understand the long-term, the monthly charts, the weekly charts, the daily charts, you will be much better prepared to make an assessment if it's going through that level. The worst thing you can do is just decide, you know, I'm going to put the trade on there. You want to have some context behind it. Okay, other questions?
How does tomorrow's employment number affect your trading?
Uh, Generally speaking, people have been with me for a while, know that the employment number rarely has any real meaningful effect on the market. You will see many times that, you know, you get some increased volatility, but the net effect when the day is over is pretty muted. The reason for that is that it's a hype number used by the short-term traders. They say, oh boy, it's, you know, it's good, it's bad, or whatever, it's disappointing. But most of the really serious money, the institutional money, those that really, you know, put the money behind the market, they watch it on a weekly basis. They keep track of all the weekly numbers, and they're looking at that to see what the patterns are, rather than the one time a month number. The one time a month number, it gets hyped like crazy. You got all the people on the television getting you all hyped up, and boy, if you guess the number right, you're going to get a T-shirt or signed T-shirt or something like that. And all that really does is get you all hyped up, get you focused on their news program, but it really is not very meaningful to you. Again, when the number comes out, I do not want to know what the number is. The first thing I watch when the number comes out, and let's say the market rallies following the number. And that number comes out about an hour before the market opens. So if the market rallies and it holds that rally until the opening, then the chances are pretty good we're going to continue in the direction of the initial move. Second scenario, it rallies off the opening, but by the time we get to it rallies off the news, but by the time we get to the opening, it's back down quite a bit. That is usually a negative sign, and that is usually an indication that we're going to at least drift lower for the day. So I do not look at the number itself. I look and see what the market has reacted following the news. First, you get the knee-jerk reaction as the headline goes across. Then I follow to see, after an hour goes on, where are we as we near the open. But generally speaking, there's not a lot of net change. Is it all? Does that happen all the time? No, but on average, there's not a lot of net change. Now, what is far more important is you've got the 3As reporting earnings after the close today. You know, you've got what are the 3As? Is it Apple and Alphabet? Somebody help me out? There's three big companies reporting earnings after the close. I know Alphabet. Probably Apple. Who else? Somebody help me out.
Amazon, Visa,
Okay, Amazon. I'm looking for the 3As. So those are big
Google.
earnings. Those are big earnings reports tonight. So, you know, if anything's going to impact the market, the chances are the volatility will come in after those earnings. Okay, additional questions?
How many days do you consider POC levels to note and consider?
Uh,
Did we lose your audio there, Jim? Because I can't hear you. Are other people having trouble hearing Jim? Yeah, his looks like Jim's audio is having an issue right now. Hold on one moment. Let's see if we can see if he comes back here. Jim, if you can hear us, looks like your audio went out, and we have not been able to hear you. Jim, we still can't hear you. I don't know if you know if is your mic doesn't look like it's muted, but we cannot hear you. Sorry about that, guys. Give him a minute here and see if he can resolve the issue with his mic. Well, in other news, TGIT, thank goodness it's Thursday.
Okay, can you hear me now?
Yes, we can. Thank you. Oh, did we lose you again? I heard you there for a second, Jim. You were there for a second, and now I can't hear you again.
Testing?
Yes.
Okay.
You had gone out for another split second there. I don't know what happened.
Okay. Well, there was a click. It said use news hardware, and I clicked on it. I should have left it alone. Okay. Well, I'm glad we're back. A couple more questions.
Yes. Hold on. Let me see where I left off here. Would you consider the early trade other time frame driven?
No. When you're inside the previous day's range, more than likely you are looking at very short-term trade. Now, the move to the upside, I don't know what that was. But early on, can you still hear me?
Yes.
Okay. Well, the volume is really low on my end. Okay. Early on, if you will look at, if you're a client, you would see my Twitter comments. The first rally, I think, went up to a pretty obvious point. Then the market broke, and it broke exactly the half back. And when it goes to references that are very visual, that are typical short-term time frame references, that's usually an indication that the long time frame is really, or longer time frames, really aren't paying much attention in the market. Now, the break to the upside, more than likely, was on the next time frame, not the big investment time frame, but there are these huge pools of capital, very highly leveraged, usually hedge fund related, and our private investors with lots of money, and they can come in and move a market. But when you take a look today, we're still within yesterday's range. We had a big spike up that probably caught some shorts. No real follow through. We're now better than an hour after that, and the market, hasn't gotten up to yesterday's high, and there's no real follow through on the market. So again, we probably some short covering, but I don't see any indication of anything other than short term short-term trading money, not necessarily day trading, maybe a little more than day trading, but not the real long-term investment money that really does move the markets. Okay, other questions?
How would you view the market if it stops one time framing and the value is down, but it has a bullish bias?
It stopped one time frame, but it has a bullish. Market's down, stops one time framing, has a bullish bias. Well, again, it's not contextual. So like today, it's inside yesterday's range. So I'm spending more time saying it's inside yesterday's range and more rotational than anything else. You got to be careful not to look too hard for things, and I actually don't like the terms bullish and bearish. And the reason I don't like those terms is they're too emotional. Oh, it's bullish, it's bearish. I prefer to say, well, it's an inside day. Going a one time frame is positive for right now. That's better than saying it's bullish. Bullish is just too much of an emotional term, and it can trigger some thoughts and some hope and fear that may not be there. Okay.
Okay. Since the high is right at yesterday's value area high, do you consider today's low weak? Is it better to pay attention to the value area high or the overnight high, since both are so near to each other?
I don't focus much on the value area high or the value area low. I look to see what the value area is doing overall. For example, yesterday, as the market was breaking yesterday afternoon, the point of control didn't move, so value stayed higher. Okay. Now today we'll see what happens. If the market's up here, and if we stay up here longer, we'll pull value up. But if we start to break down here, then you may have this little rally, but value stays lower. That would not be very positive. But right now, I mean, this is F and G period exactly match. That's not strong money. That's all trading money in there when there's exactness like that. Okay.
Do you consider the 4:30 to 5 p.m. Eastern Time runoff period as part of the overnight session?
I start the overnight session at I guess it's 2 o'clock. It'd be what, 2 o'clock Eastern is what I have up here. 2 o'clock Eastern, and I'm looking, and I don't, so 2 o'clock Eastern, I guess, so 2.
That's 2 o'clock your time.
The market reopens. I may have it set for 2, but it's whenever the market reopens, it starts capturing it. I don't get really hung up, because what really interests me is when I look overnight is the overall nightly trade. You've got the US, you've got Asia, you've got London. So I don't get hung up on the exactness, but I started at 1400 my time, which would be what?
That would be 4 p.m. Eastern, Jim.
4 p.m. Eastern, yeah. So that's when I start, but I don't worry a lot. I don't worry about. No, I guess here the next one's 1600. So that's 4 o'clock. So I don't worry. I don't get hung up about it. I just capture it. I don't spend a lot of emphasis on any of it. I just look at what happened overall. When I come in the morning, am I long or short overnight? Okay?
Okay. Speaking of long-term charts, what do the multitude of epochs below tell us about the current market structure and stability?
I'm sorry, repeat it?
Speaking of long-term charts, what do the multitude of epochs below tell us about the current market structure and stability?
Okay, this goes back to a question earlier. I don't, I think there's probably, people throw around the term epoch all the time. I don't think it's that relevant. I use it more for the day time frame than I do for anything else. I don't combine charts. I used to combine, several days, but that left out a lot of detail. I think you can get too focused on things like the point of control, and I don't use value points of control. I use the TPO points of control, and the reason I use the TPO points of control is because they include time. The value points of control do not include time. Market price advertises opportunity, time regulates all opportunities, and volume measures the success or failure of those advertised opportunities. Just using the volume point of control does not include time, and I think that's wrong. So I use the traditional point of control, which is, established by TPOs reading from left to right. Okay?
I have heard that only in 2 to 3% of the days, ES will fail to take out either the overnight high or low. Could Jim comment on this, if this is true?
I don't look at those things. People sell services that have all kind of statistics. How many times is the low made in I period and the overnight high and low? I don't pay any attention to it. I just simply look at the overall market. The only thing I do pay some attention to is that, so many times a very high percentage of the high or low for a day is made in the first hour or two. Yesterday's high was made early. Today's low, at least so far, is made early. If you go back, here's another day. The high was made early. A high was made early. A high was made close to early. The low was made early. The high was made early. So I do look at that. That a lot of times the low or high for the day is made in the first couple of hours. I will look at that. I also look at where is value developing. Okay.
Just a comment and a clarification. Basically, you had said 6 p.m. Eastern with regards to the overnight when you look at that and that starts.
Okay.
And you said 6 p.m. in yesterday's webinar because somebody asked that question as well. So just clarifying that.
Yeah, I guess this has got it. One of them I've got there is picking it up at 2 my time, which would be 4 Eastern. The other is picking it up at 1600, which would be 1600 my time, which would be 6 o'clock Eastern. So I don't get lost. I don't get lost and try to be exact on it. I want to see the overnight range, and I actually really look hard at anything that happens after 4:15, which is the final runoff for me. That's the final runoff I look at. Okay, what else we got?
Do you trade mostly futures or do you trade individual stocks as well?
I trade mostly futures in my trading accounts. I'm talking to you about. In my investment account, I'll trade a few stocks. I put Amazon. Not Amazon. I've got Walmart in there. I've got a couple of other stocks that I have for long term, but mostly I will trade ETFs, the SDS and the SSS, whatever, the long and the short, double S&P. I will trade those, and sometimes I'll trade other ETFs, but I don't have a lot of stocks, and I don't do a lot of trading. I'll put some stocks in there for investment purposes. I only put Walmart in there because I got it at a pretty good price, and I didn't have the stomach to buy Amazon, which of course I should have. Okay, couple last questions.
Oh, Jim, can you expand on poor lows being sometimes due to inventory being too short or vice versa with highs? I have a hard time grasping this concept.
Well, just think about it. Okay, yesterday, we had a poor low yesterday. If you were watching us and the market sold off and rallied, sold off and rallied, sold off and rallied, and we were talking about, is the market getting too short? sold off, it rallied. And finally, it just got so short that it rallied all the way back. Well, I think that's just, if you're short and you're nervous and it goes down to a previous low, you have a tendency to say, oh boy, I'm going to take this thing in. I'm uncomfortable with it. So it's just, you may have trouble with the concept, but it's just an indication, something that I discovered over after a few years of trading the market. And, because I'd made some mistakes of putting too much reliability on or relying too heavily on a poor high or a poor low. And it cost me some pretty good money. Because I'd said if it was short and I was short, I said, well, I got a poor low, it's coming back there. Well, I found out that got to be pretty costly. I finally got to the point, I said, okay, that poor low is one data point. And then I realized that sometimes they're caused by market being too long or too short. Sometimes they're caused by you having only very short-term traders in the market. But it's a single data point. That's what's more important. But yesterday, the context going into yesterday, very understandable why, the market was too short and it left that low. We went down, we went up, we went down, we went up. Point of control never moved. So the context was right for the market being too short. Okay, two more questions, please.
If the volume point of control doesn't get to a level after another period, would you take that into account?
I do not look at the volume point of control. I don't know how many times I've said it. I do not look at the volume point of control. I look at the regular point of control. I look to see my point of control. I look to see if it's rotating up or down. Okay, final question.
Somebody's asking opinion on the current market conditions.
Well, currently, I mean, we've got an inside day to day. We've got really a 3-day balance in here. When you take the last 3 days, we've got a 3-day balance. We don't have anything that suggests the high is any good. We've got a poor low. We got an overnight low that exactly touched or one tick above last week's low. I don't see any confidence in either direction. What I see is a 3-day. I see a 3-day balance. So balanced trading rules are going to be applicable to me for tomorrow morning. One, if you stay in balance, then you're going to continue more than likely to have rotational trading. If you look above the high, do you look above the high and fail, or do you look above the high and start to accelerate up? Those are two choices when you're trading balance. Stay within balance, look above the high and fail, look above the high and accelerate. Same on the downside. Look above the low and fail, coming back in. Look above the low and accelerate lower. If you look below the low and come back in, or look above the high and come back in, the destination trade or the potential trade becomes the opposite end of the 3-day balance. So I look at this market as being a 3-day balance. We've got big earnings reports tonight. We've got an employment report tomorrow, and we've got a market that really, after the liquidation, it really hasn't made its mind up of what it wants to do. I do factor in, I've got an all-time high made in the overnight market. I carry that forward. It does bother me. But I also know if there's anything on the downside meaningful, I've got to get below 2809.25, which was last week's low. And that would be the first indication that maybe we've got something in here that's a little more potent than just a short-term correction. Okay, final question, and then we're cutting off.
Okay. When they say buy under the value and sell above the value, what value is that? Is it volume or TPOs?
Well, number one, it is, I use the TPO. But just to say, mechanically say, buy below value, sell above value, I don't think that's really very helpful. It sounds nice. And I remember the first time it came out of Peter Stottlemyre's night, you buy below value and you sell it at or above value. It sounds very nice. But when you take the total context into play, there's other things that are more relevant. to me. We came in today. It was an inside day from yesterday. We got a relatively narrow base, and then we had some short covering, and we ran to the upside early this morning. Not terribly. I mean, I missed it. I was caught off guard. But it's still an inside day, and there's not a lot going on. We're down. You can see we're matching lows. We're 3 wide across here. So we made this big run up, and now you're getting a kind of a P formation, like it looks all we had was some short covering, in there. Nothing else. So overall today, but I don't get into these things that are mechanical in nature. Do this, do that. Always have to, if you're going to really compete in the market, you have to understand and appreciate the context. And, that's what we're going to be continually working on in the intensity context. It is just so important. Like this morning, I put out a comment that early on, the market went exactly the half back. Then the market came back down. It took out the half back in C period by a few ticks, and then the market, started to work its way higher. I don't remember if that's exactly how it happened, but when I saw it was exactly at half back, that's a weaker buyer. Took it up almost to the high, came back, took it out. I'm looking at those things for my short-term trade to see what is really going on in here. And at that point in time, it just looked to be, fairly short-term trading money. That doesn't mean that later somebody doesn't come in. And I suspect that later they came in and forced the short covering. What'll happen sometime, I talk about these pools of money that are not long-term investment money, but they're large pools, and they're outside of the day time frame. If they sense pretty accurately that the short-term traders are short, they will come in and buy the market, or we say they will bid the market up, forcing those short-term traders to cover. There's a lot of games that go on out there. There's nothing wrong with it. They just sense that the inventory is too short, and they'll come in and they'll force the covering. It used to happen with floors all the time. You always had a couple traders in the crowd that were bigger than most, and they knew when the floor traders got too long or too short. And let's say the floor traders were too short. All of a sudden, some of these big traders would stand up, and when you're on the floor of the chains, if you got your hands, your palms towards your face, your hands up in the air, your palms towards the face, you're bidding. So they would say, I'm bidding. I'll take all you've got. So that meant they were bidding. And the short-term traders that were short, all of a sudden, they scramble to cover. And then the market makes a big run. And as it really gets runs to short-term covering, short covering is going on, all of a sudden, these big traders would go palms out, which meant they're sellers. They'd go from buyers to sellers as these guys were covering their shorts, and then they would take profit by selling into the short covering. Okay, that's what happened on floors all the time. And if you looked on the, if you look at our website, you'll see a pictures there of my floor badge from the CBOE and the Chicago Board Options Exchange. For the Board of Trade and the Chicago Board Options Exchange. And, that's the stuff that happened. And the same thing happens in the larger markets. These pools of capital that are larger than the day time frame trading they do the same thing that the floor traders used to do. The big floor traders used to do the small floor traders. If they knew they were short, they'd come in and they bid the market. And I'm guessing that's what happened this morning. All these pools of capital out there, since the market was short, they'd come in, they bid the market, and all of a sudden, all the people short, they're running to cover, and then it did nothing else, right? It's 2 hours almost. We're in this very tight range. Now they're testing the upside again in here. Okay, let me say thank you very much. I'm doing again to come back and invite you to take a look at, the offering that we have right now for the intensives. They start the 26th of February. However, anybody that registers, the early registration bonus is that I'm doing the morning report, evening report, and I'm doing chat comments throughout the day right now. I type it in and it appears on your computer screen. And if you got Twitter, it automatically feeds it over to your Twitter.
Can you go to
account.
the next slide, Jim, so they can see the codes in case anybody needs to write those down?
Okay. So that's, it's a very serious program, very serious effort. And I would really love you to take a look and join us. So let me say thank you very much, and we'll see you next time. Bye now.
Thank you, everybody, for attending this webinar. It will be recorded and posted later today. You'll be able to find it on our public web. Go to the tab where it says resources on our website, and under there you'll see public webinars, and that's where we have our public webinar schedule for upcoming webinars and as well as the recorded webinars. If you have any questions, please give me an email at dalton@jimdaltontrading.com. Thank you very much.